Warren Buffett is history's greatest investor, and today we're going to unpack 4 lessons from his writings that have made us better investors. Welcome to Get Started Investing, a show that helps you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Warren Buffett announced his retirement earlier this year, and it feels like we're doing a bit of a Warren Buffett retrospective across all of our podcasts here at Equity Mates.
A slow walkout till the end of the year.
Yeah. But I mean, to be honest, he's got 94 years of wisdom for us to draw on.
Yes.
First
decade
only. First 11 years of his
Yeah.
life, he wasn't doing much investing,
No.
but he did start investing at age 11.
Yes.
He's now 94. For people who are unfamiliar with Warren Buffett, he's the CEO of Berkshire Hathaway, and he has, I would say, the best long-term investment track record. For 60 years, he's grown money at 20% a year. His personal wealth is $170 billion. But I think more importantly, for people that came along on the journey with him, he turned $100 invested in 1965 into multi-million dollar portfolios.
5.5 million.
Yeah.
Incredible numbers, incredible success, and there's a reason that everyone turns to him for, I guess, to become better investors just like us.
Yeah. No. To be clear, you're not saying better investors like we're the better investors.
No.
You're saying we're the people trying to become better investors.
We have turned to him to become better investors.
So on today's episode, we're going to unpack 4 big lessons that we've learned from Warren's writings and his example that have made us better investors. But before we do, we want to say a massive thank you to our long-term sponsor who helps us keep all of our content free here at Get Started Investing. And that's BetaShares Direct.
That's it. BetaShares Direct offer 10 flavors of low-cost diversified managed portfolios. So there's one for everyone. And more importantly, zero brokerage applies to these portfolios. So every time that BetaShares experts rebalance the portfolios for you, there's no wealth leakage in the form of brokerage.
Love that. If there's lessons we've learned from Warren Buffett, it's that good investing requires diversification, discipline, and a systemic approach that minimizes the influence of human emotions.
Big time.
And luckily, BetaShares Direct have built a platform and their managed portfolios to help us do that.
So head to betashares.com.au/direct and see which one suits your needs.
BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info on other fees and costs.
All right, 4 lessons from the world's greatest investor. Lesson number 1, Ren, is investing is simple, not easy.
Yes.
Don't get confused there.
Important distinction. So Buffett is famous for some of his folksy wisdom and quotes.
Yeah.
Rule number 1, never lose money. Rule number 2, never forget rule number 1. The most important thing to do if you find yourself in a hole is to stop digging. Risk comes from not knowing what you're doing. He's full of pithy one-liners, but I think they really serve to remind us of how simple investing can be at the end.
Yeah.
Find great companies, hold them for the long term, let them compound and do their thing. But just because it's simple doesn't mean it's easy.
Definitely not. I think some of the examples that he has shown us around patience, staying calm, having a good long-term investing temperament, those things are actually very hard to do. Very simple to understand, but very hard to execute, particularly in the early stages of your investing journey. And I think we can look at ourselves and certainly point to moments where we haven't been patient, we haven't been calm, but they are simple concepts that have proven very successful for Buffett.
Yeah, so what Buffett hasn't done in his 60 years of managing Berkshire Hathaway is chase the hot stock, the latest trend, the new technology that's coming through. He didn't invest in a technology company until 2016 with Apple.
I know.
He's not chasing the trend. He's not getting caught in FOMO. He literally moved from New York. You know, he studied under Benjamin Graham, worked under Benjamin Graham, but he moved to Omaha to get away from the Wall Street hype and the Wall Street noise. And so I think, you know, he recognized the importance of good investing temperament, and he's a living embodiment of what that can be.
Absolutely. Lesson number 2, time in the market beats timing the market. Something we've spoken about plenty of times here on the show, and a couple of quotes that are our favorite from Buffett's time in the market. He says, "Our favorite holding period is forever. And if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. And really what he's saying or illustrating here is the multi-decade horizon at which he is looking at making investment decisions.
Yeah, and what happens when you're a long-term investor, when you're thinking in multi-decade time horizons, is that you live through some big crashes. We counted back. Buffett has lived through 15 recessions. And depending on how this year goes, he might make it to number 16.
What a retirement gift.
Look, we won't list them all, but I think it's just like these market crashes are a feature of long-term investing. That it's a natural part of the boom and bust cycle of capitalism. But the lessons that we learn from that are, number one, the market always comes back. It always has come back historically. If you look back in history, there's never been a dip that you shouldn't have bought. But also the way Buffett acts during those crashes is that he doesn't panic. He doesn't try and time the market. He doesn't try and sell at the top and then wait for the market to hit the bottom to buy back in. He just holds through. If he has cash on the sideline, he looks for opportunities and tries to put more in. And I think that's an example we can all learn from.
Yeah, well, to illustrate through some of his more well-known quotes around market timing, he says, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies.
Nice. Love it.
Simple.
Love it. Yeah. So we did an episode titled "Don't Panic. Here's why time in the market beats timing the market." So you can go and listen to that if you want us to unpack, I guess, some of the research and some of the evidence that sits behind this lesson. We looked at some of the numbers, some studies from some of the big financial institutions to really illustrate this point.
Yeah.
But Bryce, let's move on to lesson number 3.
All right. Boring investing equals exciting returns. I think Buffett has been a great example of this. His quote, "Beware the investment activity that produces applause. The great moves are usually greeted by yawns." And I think you can even start, I think, his approach to how he's going to manage or suggests managing his money post his death, which is to put 95% of it just into the index, is a great example of, I guess, a boring investment approach that we know produces exciting returns. So some of his well-known investments are certainly, you could classify as boring, but have been incredibly successful.
Yeah, I think most people would. Coca-Cola, American Express, the Washington Post, arguably Apple, not as boring, but that's a more recent investment. And then a lot of the companies that he's bought the whole company, See's Candy, Geico, like none of them are the sexy, exciting names. But what they do is that they are well-run businesses that produce a lot of cash, and then that cash gets reinvested to grow the business, and so on the cycle goes. And even just, the Buffett isn't trying to be the best fund manager in any given year. There are fund managers on any year that will do better than him. So he's often seen as boring just from the cohort of fund managers that he's compared to. But the thing that he does that those guys don't do is do it consistently and do it over a long period of time.
Yeah.
So to put numbers to it, Buffett returned about 20% a year on average over 60 years. And Berkshire is now $1 trillion company, and Buffett has $170 billion. There are fund managers that have returned better than that. Renaissance, which is a famous quantitative trading firm, they were returning 66% a year. Peter Lynch, who's quite a famous investor, back in the 90s was delivering about 30% a year. These are meaningfully higher numbers than Buffett. But what none of those guys could do is do it for as long as Buffett.
Yeah.
And so that's why we say boring investing, long-term, stable investing delivers exciting returns.
Absolutely. Now, if you're interested in learning more about picking individual stocks, we have created a 4-step checklist to analyze any stock. It's a downloadable resource, free to anyone. So there'll be a link in the show note, as we said, takes you through how to pick those boring winners. Lesson number 4, do less and let compounding do its thing.
Nice. A quote from Buffett: "In the end, it's not the daily fluctuations that matter, but the compounded growth over decades."
Yeah, shit.
Now, if we look at Buffett's life, he started investing at age 11. He became an investing phenom in his 30s with the Buffett partnership. And yet 99% of his wealth was built after the age of 50. At age 50, he was worth $100 million. Today, at age 94, he's worth $170 billion.
There's hope for us yet. There's hope for us yet.
Even if we don't reach those highs, I think the important thing to note is that we're all of our wealth, if we're investing regularly over our lifetime, our wealth will grow in a similar pattern. Like the compounding really happens in the later years, because it's just about getting a consistent return each year, and then you've got a higher base. You make a consistent return on that, you've got a higher base still, and the numbers start to get really big in the later years.
Yeah, I think the second part to this lesson is to let the compounding do its thing. Don't touch it, don't overtrade, do less.
Yeah.
Do less. Warren said the difference between successful people and really successful people is that really successful people say no to almost everything. I love that. And he says, I insist on a lot of time being spent almost every day to just sit and think. Must be nice. That is very uncommon in American business. I read and think. So I do more reading and thinking and make less impulse decisions than most people in business. And I think if you have that temperament and the ability to action that, then his results speak for themselves.
Yeah. So if we summarize our 4 lessons, I think one of the key themes is exactly what you just said there, is around temperament, because as we've learned, investing is as much behavioral as it is academic. It's about how we control ourselves and our emotions and our behaviors. So the 4 lessons: first of all, investing is simple, not easy. Secondly, time in the market beats timing the market. Thirdly, boring investing equals exciting returns. And finally, do less and let compounding do its thing.
Yeah. All lessons that we can absolutely action ourselves. I think none of those to me stand out as needing a degree in finance, needing to be a professional investor. I think, you can action all of these, even within your core portfolio, and be a very successful investor over the long term.
Yeah. So that brings us to the end of this episode. We hope you enjoyed it. If you did, make sure you're subscribed wherever you're watching or you're listening so you don't miss another episode. While you're subscribing to things, also subscribe to our daily news email. We'll give you a short, sharp summary of the news you need to know, and then you can do less. You can stop and think.
That's it.
Because you're caught up on the news that you need to know. And we want to hear from you. If you want to join the conversation and join the show, you can send us a message or leave us a voicemail. The link is in the description or the show notes. And finally, Bryce, as we're asking for things, the number one way any podcast grows is by word of mouth. So if you did enjoy this episode, if you've subscribed to everything that we're promoting, if you want to do more for us, tell a friend, tell a family member, tell someone you think may enjoy it, because it really does help us grow.
Send it to Warren. I think he'd love to hear it.
We did send our book to Warren.
We did.
Now, unconfirmed if he ever read it, but we did get tickets to the Berkshire Hathaway annual general meeting.
Yes.
Like, we weren't special. Like,
we were shareholders.
We were shareholders. We were entitled to tickets.
It had nothing to do with the book.
But the team did write back to us.
They did.
Yeah.
Yeah.
So that was nice.
That was nice. We saw his house.
No, we didn't get invited to his house. We just drove.
We drove to it.
We drove to it.
Threw a book over the fence. We didn't do that.
Anyway, we're waffling. So.
Yeah. That brings us to the end of this episode. Stay tuned. Next episode, we are looking at the best ETFs for a rate cut.